Good day to everyone. I'm Jacqueline A. Olarte, and I'll be reporting the case study number 2 from chapter 12, which is the audit of trading securities. So the problem is Hector Santos, an investor in Amarillo Corporation, asks you for an advice on the propriety of Amarillo's financial reporting for 2 of its investments. So you obtain this following information, which is related to the investments from Amarillo's December 31, 2016 financial statements. So first, there is a 20% ownership interest in Azul Corporation, which is represented by 200,000 outstanding ordinary shares, which was purchased on January 2, 2016 for 1,200,000. And 20% ownership interest in Western Corporation, represented by 20,000 outstanding ordinary shares, which was purchased also on January 2, 2016 for 600,000 peso. And on January 2, 2016, the carrying values of the acquired shares of both investments equal to their purchase price. And on the year ended December 31, 2016, Azul reported earnings of 800,000, and also on the same year, Azul declared and paid dividends for amounting to 200,000 pesos. And next is Western reported earnings of 700,000 for the year ended December 31, 2014, and on 2016, Western declared and paid dividends for 200,000 pesos. On December 31, 2016, Azul's and Western's ordinary shares were trading over the counter at 36 pesos and 40 pesos per share respectively. So 36 for Azul and 40 pesos per share for Western. And the investment in Azul is accounted for using the equity method, while the investment in Western is accounted for as available for sale securities. So here we calculated the amounts reported in Amarillo's December 31, 2016 financial statements and determined that they were correct. So stressing the information available in the financial statements was limited, you advised Santos that assuming properly applied financial reporting standards, Amarillo may have appropriately used 2 different methods to account for its investments in Azul and Western, even though the investments represents equal ownership interest. So these are the requirements for the problem. First is prepare the journal entry for Amarillo's investment in Azul Corporation on January 2, 2016. So here is the answer. Debit investment in Azul Corporation, credit cash which amounts to 1,200,000. This was the purchase price of the investment of Azul Corporation. And the second requirement was prepare the journal entry for the dividends received from Azul in 2016, which was 200,000 given. But since there is a 20% ownership interest, you have to multiply it to the 200,000 investment times 20% is equal to 40,000. So debit cash credit investment in Azul Corporation amounting to 40,000. So the third requirement is prepare the journal entry required for Amarillo's reported income for the year ending on December 31, 2016. So as you can see, it's only Azul Corporation. There is no Western Corporation, for the reason that the earnings for Western was for the year ended December 31, 2014, and what is asked was for the year ended December 31, 2016. That is why it is only the Azul Corporation. It is written in the journal entries. So debit investment in Azul Corporation, credit income from Azul. So sa 800,000, this was the reported earnings for Azul in 2016. You have to multiply it to 20% as the ownership interest, and you can get the amount 160,000 pesos. This is it. And the fourth requirement is to identify the following amounts on Amarillo's financial statements in this table. Okay. So the fourth one, this is the fourth requirement. carrying value of Azul's investment is 1,320,000. So how did we come up with this amount? So let's find out. So in the statement of financial position, in Amarillo reported its investment in Azul at a carrying amount of 1,320,000. The calculations for this one is equity and earnings, which is 160,000. You derive from 800,000 times 20%. This was the investment of Azul in equity earnings. The next is the dividend received, which was 40,000. 200,000 nga dividends declared and paid dividends, then 20% sa ownership interest. That is why there is a 40,000. So the carrying amount is equal to 1,200,000, which was the purchase price for the investment or the original investment of Azulco, plus 160,000, the equity and earnings, deducted by the dividend received, which is 40,000, is equal to 1,320,000. So the dividend was deducted. It's because dividend serves as an income for the investor, so it is not part of your investment. So when you invest something, in return you get a dividend. That is why in calculating the investment in Azul, the dividend should be deducted, since it is not part of the investment, it is part of the income of the investor. Okay. Next is the carrying value of Western investment. So we have 800,000 peso. So where do we get this 800,000? A statement of financial position in Amarillo reported its investment in Western at a fair value of 800,000. So, excuse me. The calculation for this is 20,000 shares times 40 peso per share, we get 800,000. So why does it reported at a fair value for Western? Because based on the problem, the investment of Western was accounted for as available for sale securities, so it is for sale in the market. That is why we report, or it is reported in fair value, because it can be sold to the market. Unlike for the carrying value, it is for the balance sheet. So that is why we reported it in this fair value of 800,000. And 20,000 shares, you can get it from the given, and also this 40 pesos per share. That is why we have 800,000 peso. Next, the income on income statement. So first is Azul investment. For income for Azul, we have 800,000, which was reported in 2016, times 20% the ownership interest, we can get 160,000. For the Western, we have dividend income, which is 24,000. So we derive this 24,000 from 120,000, which was the dividends from Western, times 20% ownership interest, we can get 24,000. Now, why is it that there's just a dividend income and income from Western? It's because the earnings that was reported from Western was on the year 2014. It was not on the year 2016. That is why only the dividend income was being recorded or computed in the income statement, because it was on the year 2016. Next is the other comprehensive income. So as you can see, there is no OCI or other comprehensive income for Azul. It's because the investment for Azul was accounted for equity method, while in Western there is another comprehensive income, because then the investment was for available for sale securities, and this available for sale securities, this item is included under the other comprehensive income. That is why included That's why it is included in other comprehensive income here. So we have an unrealized gain 200,000 from Western investment. So the calculation for this is 800,000. This was the fair value of the Western's investment, 800,000, minus the 600,000, which was the purchase price or the original investment of Western on January 2, 2016. So you have to deduct it from its market value or fair value. You can get 200,000, which is the unrealized gain. So that is how we get all the amounts here in this table. And that ends for my report. And thank you for watching, and power. Laban lang.